I would like to highlight the key features of margin trading. I want to talk about the characteristics of uh, margin trading, a kind of beginner's guide to this particular practice. So, margin trading involves borrowing funds from a broker to trade financial assets, enabling investors to control larger positions than their available capital. So here are the key features of margin trading. Number one is leverage. Essentially, margin trading is all about borrowing money. That's it. It works on the principle of leverage. So the margin trading, allows investors to borrow money to amplify their investment position. You want to increase your number of shares, you borrow money to, you know, add additional number of shares to what you already own. This means you can control, more stocks or assets than what your initial capital could actually, afford. For example, a ratio of 2 to 1, lets you borrow an amount equal to, your initial investment. Ratio 2 to 1. Let's say your initial investment was let's say $100,000. You could borrow additional 100,000, making it 200,000. That's a ratio 2 to 1. So it allows you to borrow an amount equal to your initial investment. Number two is margin accounts. To engage in margin trading, investors need what is called a margin account, which differs from, a standard brokerage account. There's a difference between the margin accounts and your traditional brokerage accounts. The account allows you to borrow money with the securities in your portfolio, serving as a collateral. When they lend you money, the securities you have there in your portfolio, the shares you have in your portfolio is serving as a collateral for the money you are borrowing. So in case you are not able to pay, then they will sell your securities. They will sell your holdings. They will sell, what you have in your portfolio to be able to augment for the losses. Number three is initial margin requirements. The initial margin requirements here, is the percentage of the total trade value that you must deposit in your margin account before borrowing the fund. Before you borrow, there should be something in your accounts that will kind of, act as a collateral. These varies depending on the broker and the type of assets being traded, but typically ranges from 25 to 50%. You want to borrow, let's say you want to borrow $100,000, you should have between $25,000 to $50,000 in your accounts. So that would then act as a collateral for you borrowing additional money. So that initial margin requirement is very important. They will not give you money without meeting this particular condition. Number four is a maintenance margin. So when it comes to a maintenance margin, this is the minimum amount of equity. That's the value of your investment relative to the borrowed amount. All right. So what is your investment value, the total worth of the stocks in your portfolio, compared to the amount you are borrowing? All right. That is what is called the maintenance equity. And that must be maintained in the margin accounts. So anything below the maintenance equity, the maintenance equity, the broker will call you. You receive a margin call. And so if the account, equity falls below a threshold, below a given, predetermined, figure, then you receive a call, what is called the margin call, the dreaded margin call. There's a movie that is titled Margin Call. It's an interesting movie when it comes to stock market investing, or rather investment in general. And so, number 5 is a margin call. If the value of the securities in your account declines, below the maintenance equity, then or the maintenance margin, you will receive a call from your broker. You know, essentially, the call to do was to put in additional capital, and if you fail to do that, they would liquidate your position to be able to recover their money, or to bring the portfolio back to equity level, the required equity level. Number 6 is interest on borrowed funds. Just like all other forms of borrowing, bank borrowing, whatever, there's an interest your broker will charge you. All right, so the broker will charge you an interest on the borrowed amount, and this interest varies, and it varies and can significantly affect, the cost of the margin call, especially if the position are held over a long period. The longer the period you hold your investment, the more you keep on paying those interests on a monthly basis. That's why when I got information on my mail, in my inbox from my broker to if I'm interested in their margin facilities. When I read the terms and conditions, I said, no, this is not for me. I cannot be paying interest every month. Assuming it's when you sell, you make your money and pay the interest, it's okay, it's acceptable. But whether you sell or you don't sell, you keep on paying this money, this interest monthly. So it's not a good proposition. Number 7 is potential for greater profits or loss. The idea here is that if the market does very well, you have an outsized level of profit. But if the market goes against you, then that would magnify your losses as well. That's how it works. If the value of the assets you've borrowed to buy declines, you could lose more than the initial investment. So it magnifies your losses in the kind of. Number 8 is short selling. Margin accounts allow for short selling, where you borrow the shares of a stock to sell, sell them with the intention of buying them back when the price drops further. There's a video on short selling. It is better. This concept is better explained in that video. It's in my channel. If you go there, you search short selling, you come across it. Number 9 is risk of liquidation. If your account equity falls below the maintenance margin and you are unable to meet the margin call, that is, you are unable to put in additional capital, your broker will have no choice than to liquidate your investments. They will sell their investments, recover their money, and whatever remains, they will give it back to you. All right. So margin trading can be a powerful tool for enhancing returns, but it requires careful management, management of risk, because it can amplify your potential gains and can equally amplify your potential losses. So you need to take this into consideration before you go into. But experienced investors are really making money out of it. Experienced investors, highly capitalized, that can afford to borrow. Well, it all depends on your risk appetite anyway, but it's not very easy actually.